Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Happy Halloween to everybody. I hope you all had a very happy Halloween last night, especially all of you with children, myself included. Boy, oh boy, fun time of the year. Also a fun time of the year to be watching these markets, as on this weekend show, we're going to be focusing front half of the show on more of the metals sector, more precious metals, and potential opportunities in copper stocks. Back half of the show, going over to the energy sector, oil and natural gas. As much as they're trying to rebound, that market, we're still wondering when we're going to see a true run higher. Just as a note for everyone listening, please go back through our website, podcast, YouTube channel, and Substack account. Just search the KE Report. That's where you can listen to the full weekend show, as well as all our daily editorials covering market moves and company updates. We're kicking off this weekend show with Dave Erfle, founder and editor of the Junior Miner Junky. We held off on recording this as we usually record on Tuesday, but this week with the Fed meeting and the correction, quite frankly, the pretty rough start to the week, we wanted to wait until later on this week to get a lay of the land for the metals market. Dave, when it comes to gold is holding right around that $4,000 level. Yes, it went through some volatility and a correction early on this week, but one thing I'm noticing is it looks like, at least by the end of the week, the stocks are trying to bounce back a little bit stronger than gold. We'll see where this all goes. And you know what? This is all correction that we've been talking about and waiting for, but what are you seeing out there on the gold and gold equity front?
Yeah, it's encouraging the way the shares are acting. I mean, the gold price corrected from last Tuesday to this Tuesday, it corrected 11%, and silver corrected 16%. And you had the GDX and GDXJ correct around 20%. But at the same time, you see institutional inflows into ETFs are remaining really resilient. I mean, gold-backed ETFs, they added over 723 ounces in mid-October. And silver funds brought in 13 million ounces in a single week. So this is evidence that smart money is basically using this pullback to add more exposure, not reduce it. And it's showing up in the way the shares have bounced back here pretty quickly. I mean, last week I said that I was looking for the GDX to quickly test its former all-time high from 2011 at 67, and it came within $1 of doing that this week. And then GDXJ, I was thinking maybe a 25% correction down to 85. It got down to 88. It corrected around 22%. And they're trying to maintain those lows here as the gold price, as you said, is trying to hang around 4,000 at the end of the month here. But what's really encouraging is the action in the TSX Venture. I mean, after nearly doubling from its April low, the Venture's has only corrected 10%. That's half of what the majors have corrected. So, 50% of the venture is made up of those higher risk early stage developers and drill plays and more risky juniors. So seeing the venture only correct by 10% and seeing buying coming in here at the end of the week, that's really encouraging.
Yeah, it is. And I think a lot of the stocks, Dave, are bouncing back with volume, with more participation. It does bring up the question, though, whether this is the buy the dip moment where the people on the sidelines are coming back in that maybe missed the run and are trying to jump into some of the stocks on their watch list, or if this is a dead cat bounce that's part of a larger correction, because there's a lot of technical analysts on the Twitter sphere and still out there in the blogosphere talking about that was the end of the gold rip and that we're going to see much lower prices in the metals, but also in the mining stocks, and that we're not going to see those peaks again for a long time. What's your thought? Could this be a dead cat bounce that we're seeing, even though it's exciting to see a little life come back in right away? Are people setting themselves up for the wrong expectations here?
I mean, sure. I mean, we could see another leg down. That's always possible. I think I also brought up last week that a correction down to the 3,500 area, that would be a 20% correction. That would be perfectly normal after the huge move that we saw over the past year. I mean, the gold price has more than doubled over the past 18 months. And the last time we had an 11% correction, it took 4 weeks to correct 11%. And here's it's only taken a week because it climbed so far so fast, right? Once it got to 4,000, it zoomed up to 4,400 really quick. So it's perfectly normal to see this, especially after the gold prices ran up so far so fast. I mean, if you take a look at what Federal Reserve Chairman Jerome Powell had to say during the conference, he was obviously frustrated because both employment and inflation continue to rise. So he's basically saying, hey, we're looking at unemployment, it's rising. We're seeing layoffs ratcheting up. And someone even asked him a question about layoffs. And you see inflation still remaining 50% above its fantasy 2% target. It's still at 3%. And at the same time, he mentioned how GDP growth is less than 2%. So that adds up to stagflation. And that's what the gold price is looking at. You know, it's looking at the stagflation that's in the system now, and that'll probably continue to come in the system because Powell blamed the tariffs, and also, you know, it's also not the Fed's fault that the government continues to borrow more money and raise the deficit that it's already in. These deficits continue to go higher, and there's no intention to pay anything off. So the Fed can't do anything about that. They can't do anything about tariffs. So they're frustrated. And if you take a look at what happened during the announcement of the rate cut, we had the Fed's yes man Mirren, he wanted to lower more, and then we had another Fed governor say that they didn't want to lower at all. So there's uncertainty inside the Fed, inside the Federal Reserve itself. There's uncertainty in investors wondering, how all this is going to resolve. And the gold price continues to love the uncertainty.
Again, we still need to see where this rebound comes because it was a quick sell-off. And even the stocks, while they are showing a bit more life, there's a little work to do on the upside. So only time will tell on that. But let's dive a little bit more into what we saw in October on the financing front. We were talking so much about how everybody was raising money. Every financing was upsized. The $2 million financing turned into an $8 to $10 million financing. $10 million financings. Now they're $100 million. We do have some data around all the financings in October, and it really was a record. So, Dave, share some of that data that you have on financings in the sector and how that carries over to when you're analyzing some of these companies, please.
Yeah, I mean, in October alone, it raised $2.9 billion across 185 financing deals. And that's the largest monthly volume for sales and of new shares by public companies in this sector since November of 2013. And there was comments by capital market executives saying almost everything's being oversubscribed, and we're seeing that. And many of these deals have been upsized. So the capital markets remain very strong. So, these companies most of them are now fully cashed up well into next year, cashed up for drill programs, cashed up to continue to de-risk late stage projects, what have you. I mean, that's very positive. And a lot of these financings in the earlier stage juniors, they're coming from strategic partners like majors and mid-tiers. That's very positive to see. And most of them are warrantless as well. The investors love to see that. So this is all very positive. And like I said, when you take a look at the action in the TSX venture, that reflects that investors see this as positive, and the weakness is being bought in these higher risk juniors.
Well, Dave, to that point then, if that much money has been raised in just 1 month, and I would say that we still had a pretty good September and August as well. So if you think about just the last few months, how much money's been raised in this sector, that can't have all just been coming from traders trading amongst ourselves. I think for several years we talked about, hey, it's just us precious metals traders trading amongst ourselves. If that's the case, is this the influx of generalist capital we've been waiting for? Is this institutions coming from outside the space getting positioned? Is this what we've been waiting for?
I mean, I think so. But if you still look at most gold developers, even after this recent move, some of them have tripled, quadrupled, even gone higher. They're still trading at a 75% discount to their net asset value based on fair value. So, even though the general public is finally starting to come into gold stocks, into the miners and the mid tiers, I still think that there's a lot of room for these developers to go much higher, because I don't think most of them have discovered the higher risk sector, the higher risk junior developers, and especially the optionality plays and a lot of these quality drill plays now.
So at least in the short term, though, with all these shares being issued, a lot through life financings too, so immediately free trading, a lot also do have this 4 month hold. So over the next, let's say, 4 months, do you foresee a slowdown in some of the momentum in these stocks because of the new issued stocks that will be free trading and that churn that naturally happens?
Yeah, in bear markets, you see these financings consolidate, lower with a lower bias. But most of them I'm seeing that they're consolidating with a sideways to upward bias as investors take a look at it as positive, especially in several of them are also they're announcing share rollbacks. And that's been greeted with positivity from the marketplace as well. In bear markets, you see these financings, these big financings, these big dilutive financings, and share rollbacks. They're always a drag on share prices. They're always a reason to sell stocks for these investors. But in bull markets, they're consolidated, and then once they're consolidated, the share prices go higher. And if a lot of these companies, they have outstanding warrants, if some of them are coming into expiring in the money, that gives the company even more money, and investors look at that as a positive in a bull market as opposed to a negative in a bear market, because these warrants, they can act as a roadblock in bear markets, but they're just speed bumps in bull markets along the way to going higher along the Lassonde curve, and a lot of these companies that are de-risking these high margin projects.
Well, let's talk about that second leg of the Lassonde curve, or the first leg of it for that matter. All this money raised ultimately is dilutive, but the idea is that the companies can go out and create more value with it than what they had previously. So they raise the money to go drill, and the drilling presents more value, or they raise the money to de-risk or permit or put out a study, and that supposedly builds value. Now, we know that reality is most of these companies are going to blow this money and not build enough value to outpace the dilution. So how do you separate the wheat from the chaff?
Yeah, that's the thing, right? I mean, we all thought that a lot of these companies were going to go by the wayside during this bear market that continued for longer than we all expected, and we thought that, hey, a lot of these lifestyle companies and these companies that really are de-risking projects that are never going to become a mine, they're probably going to go by the wayside, but they didn't. And matter of fact, I think there was even more companies added from spinoffs. So that makes it tough for these investors to get into the right companies to hold for the long term. You just have to make sure you do that, and you have to do your proper due diligence. You look at the management, you look at the project, look at where they raised money, you look at the share structure, you look at management and how much shares do they own, what do they pay for their shares, do they have a bunch of cheap shares in an IPO finance, do they participate in all the financings? You want to make sure these management teams are fully aligned with shareholders, and their projects are based inside of large district scale land packages that are eventually going to attract a major. Because while they're de-risking these projects, you want them to show proof of concept that this is eventually going to become a mine. So you still have to do your due diligence and not just buy willy-nilly in the junior sector, because sure, once these up legs happen, like we just have, everything starts going up. But you notice when we have a correction, it's the turkeys that go down the most.
It is. And look, it's been that kind of environment where you could buy anything and it went up. It does get harder eventually, but hey, it's still a pretty good environment out there. So still good to be invested. But as always, do your due diligence. Let's shift focus a little bit. We have been talking a lot about copper holding above $5. But when we look at the copper stocks, it's a mixed bag. The juniors aren't really doing much. The majors, many of them are doing quite well. And you look at COPX, the Global X Copper Miner ETF, that's been on an absolute tear, especially just in the last couple months. Quite frankly, it's straight up ever since that April drop after Liberation Day. Dave, it brings up the question to me, and something that I'm kind of seeing maybe play out here is similar to what gold did last year, where gold broke out, the majors did better, the higher quality gold stocks did well, and then we started to see this flood of capital into the juniors. Is this year, 2025, for copper, like last year, 2024 was for the gold market, where it could all be setting up for a lot more money filtering into a lot more stocks for copper, as long as the copper price stays up there, probably into next year?
Yeah, and I've been harping on this for the past several months. I was focusing more on copper. A couple months ago, I added a copper junior that was trading that was well below the radar. That's de-risking a very large project, and the stock has gone up like 65-70% since I recommended it and purchased it myself. So yeah, I mean, we take a look at the headlines here. We got Glencore, their output fell. They're down 40% since 2018 on their copper output. And the copper price in London hit a record high on supply concerns. So, the copper price is back above $5 a pound. If you take a look at the stock market, it continues to make all-time highs. Tangible assets, stocks, everything's making all-time highs here. But as far as the copper juniors are concerned, they're still trading well below fair value, I believe, especially the higher risk ones, the earlier stage ones. So, but like I said, as far as the gold and silver stocks, you have to apply that thinking to copper stocks as well, as far as picking the right ones to ride for the long haul.
Well, and Dave, copper is an interesting one in that if you think building a gold mine or a silver mine takes a long time, wait till you see how long it takes you to build a copper mine. So when you look at the economic studies, you have to factor in things like permitting, social license. Can we actually get this project built? There's a big NIMBY, not in my backyard effect with copper mines that are large. Underground mines are smaller, but they're less disturbance, sometimes easier to get permitted. But when you look at the crop of copper developers, are there anything you look at as deal breakers where you wouldn't touch it because of maybe a wart or some hair that's just too big to move it forward?
Yeah, I mean, jurisdiction is key, management is key, and like I said, size is key in everything that I buy. It has to be big. It has to be big enough to eventually attract a major or a mid-tier to take it out, and hopefully not take it out too soon. So, but in management is a big one also, I mean, the first thing I ask when I talk to companies is, I'm speaking with management, I ask them, how much do you own? How much did you pay for your shares? Are you participating in the financings? You want to make sure that these management teams are fully aligned with shareholders because, like Rick Rule has said so often, 80 to 85% of these juniors are lifestyle companies, or they're de-risking projects that will never become a mine.
Yeah, it's true, but that doesn't mean that they can't run either. But I guess on the copper front, how important is it to you that they have at least a resource and then even up from there, some sort of economic studies? What sort of emphasis do you put on those companies?
Yeah, I'm not touching drill plays yet as far as the copper market is concerned. I just added a drill play in a gold drill play for the first time in like 3 years that I really like. But yeah, it's got to have a large land package and working on a large resource that could get a lot larger. Preferably, if I can see that management sees that it's got a 20 to 25-year mine life, then I'm going to be interested. But it has to be in a really good jurisdiction. And it has to, I mean, a lot of these are low grade, these larger projects. And I like the companies that are going in and rethinking a project that has been considered low grade for a long time. That maybe they've found a high grade core, a higher grade core. I've got a couple of companies like that have done really well, where they go in and they find a higher grade core and they de-risk it from the inside, and they bring up the grade to attract a major or a mid-tier strategic partner.
Dave, when you're looking at these copper stocks, I guess in the same way that you look at gold or silver stocks, how much of it do you really factor in as far as the discount to their net present value? As far as, do you use a different multiplier? Do you discount it differently than they do in the studies? Because I still see some of these projects trading at a very tiny fraction of what they actually would be worth. I don't expect them to get full value, but it seems like the copper stocks almost get penalized on two fronts. One, on their multiplier, but also since we use typically a 10-year discounted cash flow model, if an asset's going to run 20 or 30 years, you're basically washing out the second 10 years or the third 10 years if you're only using a 10-year discounted cash flow method. So do you value them any differently?
Not really. I look at peer valuation is a big one too, because I like turnaround stories. Like I said earlier, I like companies that go in and they rethink a project that has got, it's got the attraction of being large, but the problem of being lower grade and not working in a $4 copper environment. So they'll go in and they'll take a look at the structure and say, okay, look, we found this higher grade area and we're gonna work on bringing up the grade, so bringing up the margins. So if you look at peer valuations, they're trading at a big discount to peers, even though they've got this large project. So that's a big thing that I look at right there.
Yeah, I'm with you. I like looking at all the peer comparisons too, and just seeing where the disconnects are, and not necessarily trying to anticipate where, let's say, the resource would go or the economics would go. Simply compare it to other peers and find the ones that are trading at discounts. Make sure it's not for a good reason, and yeah, that can be your opportunity. It's worked time and time again in this sector. Dave, we're out of time, but thank you, as always, for your time. I'm glad we waited for later in this week, and I hope everybody found this conversation on precious metals useful. What we're going to be doing in the next segment, again, focusing on the energy sector. So everyone, stick around. We're going to be right back.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And now we are switching our focus over to the energy sector, oil and natural gas, as we're chatting with Josef Schachter. Josef is the founder and editor of the Schachter Energy Report, as well as the Ion Energy Report. That is now on Substack. The Schachter Energy Report really dives a bit more into the companies, while Ion Energy looks more broadly at the macro factors driving oil and natural gas. Let's start off with oil then, Josef, because earlier on this week, even tail end of last week, we were getting a bit of a rebound in the oil price after it had really broke down. But now the rebound came from that $56 level up to the low 60s, 62.40, but looks like it might have topped out here, which would be another lower high. And unfortunately, it does still seem like oil's in a bit of a downtrend. Josef, talk to us about what drove this rebound and if you think that that's all that the oil price is going to get.
Well, if you remember, we've been talking for a while that I thought the price of oil based on inventory builds and demand being a little sluggish in the U.S. and China, that we were going to go below $60. A couple of weeks ago, we sent on the Friday a comment to subscribers that we broke $60, but I thought we were going to still go lower. But we were in the 58 range going back a week ago, and then all of a sudden we got the Trump announcement of sanctioning two of the biggest oil producers in Russia that are 5% of global demand, 4 million barrels a day between the two of them. 5 million between the two of them. The biggest is 3, the others 2. And then they popped, there was a large amount of retail short positions in the commodity futures. So they were reversing those positions, and that took you to that 62.40. And then all of a sudden, it kind of peaked and sluggish there. And then all of a sudden, people started talking about Russia for 2 years has been able to get around sanctions, and these two big oil companies know how to do that. They can sell to other countries. China's not going to stop buying, but they could find new buyers, or they could, do the transshipment where, they load a cargo from Russia and heads to Indonesia. Indonesia, the tanker might be 3/4 full, put in some Indonesian crude, get it labeled from the Indonesian government that it's Indonesian crude, and then they can sell that to India. So I think in the end, you're going to see no impact on Russian production. It's 9.17 in August. And if you go back to 2024, the average for the year, it was 9.19. So we're not far off those levels. And I think, you might see a month or two, as everything gets digested and Russia works out the new transshipment points and formats. And once that's done, I think you're going to see crude oil back off a little more. And I think we have a chance to get to that 56, 57 level. Given inventories, we'll get another EIA report, and a couple more will probably show demand is sluggish, and you're just seeing layoffs. Amazon, 13,000 people, and you're seeing all of the retail people not hiring for the winter, for the Christmas season, because they're worried about the demand from middle and lower income Americans. So I think that there's a likelihood that we back off a little more. And then the key thing is, we've talked before about our three signals. One is the price of oil, which we wanted it to get below. We thought it would get below 60. It did. And so that was a check mark in favor. Then you had the S&P TSX Energy Index, which is in the 280 range now. We think it's going to go below 240. So there's still a healthy correction there. And then the bullish percentage index was, 87, 88% at the high, got down to 40%, bounced to 50 on the rally because of the sanctions on the two Russian companies. But I believe as the price of oil backs off here, we'll head down again. Under 10% is a buy signal, under 5% is a table pounding buy signal. In April of 2025, we got to the lowest level ever recorded at 0%. We were in 2020 at 3.5%, and we were just below 5% in 2008. So, watching an under 10% number is critical for our swinging totally to the bullish side. We've been telling people, hold your cash, hold your cash. We mentioned a couple months ago, and we're in the 295 range, maybe take some profits, build up a little more cash, and wait for the next buy signal. And if we get a great buy signal like we did in April, below 5%, I think we're going to be saying go to whatever for each individual based, talk to your investment advisor, see what's appropriate for you. Is oil 10% of your weighting, or is it more or less? People in Alberta might take 25% simply because they're comfortable with the industry, or they have shares in companies that they work for, so that's a part of their net worth. So I think that the next buy signal will be the one where we say it's time to be fully invested.
All right, Joseph. So we'll be watching for those indicators, the price dropping back below 60 again and staying there maybe in the mid 50s, as you say, and those other two indexes reaching the target levels. Then we'll get to those proverbial table pounding buy moments. But just circling back to the oil again before we jump into some of the companies, the other factors outside of Russia, do you see anything changing as far as supply demand coming out of North America with Canada and the U.S., and or anything coming out of the OPEC plus contingency that you think maybe changes the market setup?
Well, the China numbers are skewed by them building up for their SPR, the Strategic Petroleum Reserve. They have like 750 to 800. It's the number, you can't get a tight number on that. And they want to have 2 billion barrels in their strategic reserve, or 60 days of imports. So it's a long way away from that. So they can keep on buying for that. And that's why the Chinese numbers have held in. But the China domestic market utilization is much down because of the consumer problems there. In the United States, you're looking at year-to-date demand 20.3 million barrels compared to 20.17 last year, so it's up 0.8%. But gasoline demand is 8.78 million, down from 8.86, so it's down 0.9%. So there's that domestic consumption comment. And we're looking at, a lot of, because of the growing production from, the Permian and the Eagle Ford, the United States is selling that light crude because the refineries in the Gulf Coast and the Chicago area are built for heavier crudes. So the exports last week were 4.2 million barrels. And so the light crudes that are from that, southern part of the U.S. are being exported. and they're bringing in more Canadian heavies, so we're benefiting from it. The one wild card I would mention is if there was a regime change in Venezuela, Maduro gone and the left side of the running the country and the Democratic elected government that won the election, but Maduro changed the ballots and said we won. If there is that reversal of leadership, they could open the door to allow foreign companies, especially U.S., to come in and get their oil production up. And that's an important one because Venezuela was producing 936,000 barrels in August, and they could produce 2 to 3 million barrels, which means they're closer to the United States. And if the American companies are producing it, we may lose some of that market. And that's why I think the issue of TMX and the battle over tolls is going to be needing to be resolved. And then the TMX needs to start planning the expansion. And then remember, we always have rail on top of that. So, I think that the bottom line is Canada needs to find more markets for our heavier crudes, simply because if you believe that at some point Venezuela will change and they open the doors to investment in especially their energy industry, then I think the Canadian producers were going to have new markets. So that's, I think, a pressure point with Carney, where he realized that the Americans are serious about regime change in Venezuela.
Joseph, I know you follow Canada very closely, but I am just curious in terms of your outlook or assessment of U.S. production, because the U.S. is such a key global player in the oil sector with how much production they have. We have seen rig counts continue to broadly decrease, but production has not followed. I understand they're more efficient. They're drilling the maybe easier areas, but do you foresee at all U.S. production ticking down at all?
Well, if you go to last week's EIA data, it was 13.6 million for crude oil and then 10.1 for natural gas liquids and renewables. So all in, you're talking 23.7 million of production. And as I said earlier, demand was only 20. So there's the reason why you're seeing those big exports. The reason I think we're seeing tier one inventory continue to be drilled, the efficiencies you've talked about. And the big players are like Exxon, have 1 million barrels, and they're talking about growing production to 2 million. So the big boys are there, and they're going to take a long-term view rather than if you're an independent small producer where you say, look, the money's not there, I'm not going to do it, while an Exxon is thinking, years and years in the future. And so they would be willing to make the investment, even though the price of oil may be low today, but they want to be ready for the markets, longer term. So I think you'll see flat production in 25, 26. And then if we're right that in the second half of 26, we get over 70, maybe over $75 a barrel, that's when I think you're going to start seeing people take a more positive approach and the U.S. production can grow. I'll be watching one company, particularly Freehold Energy Royalty Company. They have a big portion of their production from the United States. So they'll be talking about what's going on and, the drilling that's going on, the production they're getting from those areas. And if you go to Q2, their growth in the production was in the United States. There was not growth in Canada. So we'll be watching both the numbers to see if, because they're in the Clearwater and, other areas of the oil side in Canada. If they're not seeing any growth and they see growth in the States, I think it tells you that being involved with the biggest operators, which they are in the U.S. basins, that tells you that you're going to see growth in the U.S. production capacity.
Well, we've talked about oil. Let's shift it over to the cool time of the year and nat gas, where you start seeing that seasonality factor. I guess we can look at the U.S. NYMEX or the Canadian AECO pricing. Any thoughts on nat gas?
Yeah, nat gas, has been trading, 330 to 350. It's backed off a little today, but I think we're looking, as we get into November and the cold weather starts into the, mid part of America and of course across Canada, I think we'll start seeing, U.S. prices getting into the, $4 range and then spike if there's very cold weather and you have more than 200 BCF drawdowns on a weekly basis when you get to the very cold weather. And just watch that Arctic front go down to Texas and you'll see much higher prices. And in Canada, we've recovered, to $1.05, I think, today. But I think, once we get all of the facility stuff that's done, and we get back to the drawdowns, which starts November 1st, I think we'll be looking at $2.5, maybe late November, December. And then if the cold weather really hits and we have big drawdowns of inventory and we're near full capacity, that's going to be a big help to get the Canadian price up. And I think that's going to be when we start seeing strength. The big thing for the industry in Canada is we need to get LNG Canada running at full capacity, 2 BCF versus 600-700 million a day. They can fill, quite a few more tankers if they have the productive both trains working. And if it gets to 2 BCF by June, July, that would be very positive because it would mean they would be drawing gas on a regular basis that might go into storage. And so storage won't fill as fast. And that would be positive for the 26-27 cycle. And I think we could be looking at $3-4 for AECO, higher prices in the coldest part of winter and lower prices during the shoulder seasons. But a $3 handle for the average for the year would be well received by the industry for AECO.
Joseph, just by outlining those price targets that you have, is there any potential that the natural gas market, either in Canada or in the US, is set up for some sort of explosion higher in price? It just seems to me like the nat gas market has been relatively constrained and kind of boring, actually, for a market that can be much more volatile.
Yeah, I think that the two things will be, the one that everybody always talks about, weather. If it's cold in the United States and the drawdowns are very big, that will be a positive, because once you start draining those storage and you have more LNG coming on, you're not going to fill storage as quickly in future years. So that would set up a long-term, very bullish cycle for natural gas in the United States. And in Canada, as I said, if we get LNG at full capacity, they make the decision for a second phase, and then and that gets pushed through with support of the federal government. And then if we get the other projects moving, wood fiber and cedar and all the others moving forward, people will see that there could be 6 to 7 BCF of demand by the end of the decade, and the industry is not set up to provide enough to drill and produce that amount of natural gas at the present time, which means number one, you're going to see the industry need higher prices to justify that spend. It takes time to build the facilities, the pipelines, the major facilities for separating the gas from the oil and all the rest of it that you see the industry needing to do. If that's the case, it's gonna set up a very, very bullish cycle for the sector in Canada as well, but behind the United States.
Joseph, in addition to the narratives around weather in the seasonality of natural gas and also the LNG export terminals, both in the U.S. and Canada, the other big story that seems to be gaining ground, and love you to weigh in on it, is natural gas for power generation as far as AI data centers. And depending on who we talk to on the show, if we're talking to people in the uranium sector, they're all in on the nuclear, and there's a lot of deals with tech companies in nuclear. If we talk to people in silver, they're big on solar panels and how renewables are going to save the day. But it seems like natural gas is that transition power source for a lot of these AI data centers. Do you think that could be a value driver that's not getting as much airtime, but will grow over the next year or two?
I think that will get the most attention because these small modular nuclear reactors, they're still in the design phase. They don't have anything that's been approved. Nothing has been built. So it's a, late decade opportunity, not, near term 1, 2, 3 years. LNG facilities can be built a lot quicker. The pipeline infrastructure is already in the United States and Canada for it. And what's happening is the companies are being told, we don't want you draining our grid because we don't want home heating, home prices for natural gas to go substantially higher. So we want you to provide your own power for your data centers. And most of them are looking at the natural gas option. And you can just read in, when you see TC Energy Report or Enbridge Report, you're going to be hearing more and more about that data center demand, and that these guys will be providing the natural gas to go into those power plants that are going to be both for the normal power providers as well as for the data center people who are going to need a direct supply into their power plants.
All right, Joseph, time to move over to the equities. I want to start off with earnings season. We're still early on for Q3 earnings, but curious what you've seen in terms of the earnings front for either oil or natural gas companies, where again, we were in a very, I would say, price constrained environment for both oil and natural gas. So what are we seeing on the earnings front and what are you expecting?
Well, the only one that's reported so far is Whitecap on the producer side. And in their MD&A, Management's Discussion and Analysis, they show their average WTI price for the quarter 64.93 versus 75.10. That's US dollars. If you put it in Canadian dollar terms, 89.43 versus 102.43. And then natural gas, if you go to AECO, 63 cents versus 69. So if your volumes are the same, you are going to see, your cash flows down, your free funds flow down. But if you're, in the other case, they were merging with Veren, so they have a larger production base. And even though they had that larger production base, they still had slower funds flow. I'm just going to pull that up. And the funds flow was less than, it was more in dollar terms, but it was less in terms of percent, per share, simply because of the fact that the prices were lower for the both of those commodities, and that is really the key. You need to have much higher prices for them to really show better numbers. So they did in the quarter 73 cents, and if you go to Q2 of 2025, they did 76 cents, and in 2024 on much lower volumes, they did 69. So when you take into account the greater volumes and the rest of it, they really, on a unit basis, were less profitable than they were, a year ago and in Q2. So the commodity deck coming down shows there. And again, we're going to see a lot more companies report later this week and a big amount next week. And, that will be the tell for companies. And if many of them just focus on keeping production flat, then we're going to see cash flows, free funds flow numbers come down. And then it'll be a question about how much money did they spend for keeping their production flat? And if they had debt, did they pay any of the debt down? A lot of them that have debt have been saying that's their main focus, getting debt down and trying to keep their production flat. And then if they do have a dividend, they have the battle. How much do we pay down debt, and can we continue to pay the dividend? If we saw a couple of quarters here of sub $60, I think we'd see some companies cutting dividends. But I'm in the optimistic camp that once we get into winter, mid-November through mid-December, I think we'll see oil prices north of 70, and then that'll take the pressure off from having to do something.
Yes, the tug of war between paying down debt and paying dividends, and investors wanting to see those dividends locked in, but companies having to make some hard calls if pricing stays under pressure on the oil price. But you bring up an interesting point with Whitecap about how some companies are using M&A to also build out their future growth or bring down cost or change the dynamics. You had a couple other companies we were talking about off mic that are also in the M&A process right now. So maybe let's talk about mergers and acquisitions and how you see that setting up.
Yeah, I think, that's really a critical one, because in the case of Whitecap, they bought Veren, and so they went from 173,000 BOEs a day in Q3 of 24 to 374,623 in Q3 of 2025. So a big number. And for the 9 months, 283,000 versus 173. So a big merger like that, which was for shares, really helped them. We've seen, two more that have happened. Step Energy originally got a $5 bid, from ARC Financial, which has the private equity side that owned a big chunk of it. The minority shareholders, which they needed a big support from, didn't support it. So they came back as, without the takeover. They then, ARC went to those reluctant owners and made a proposal. And the bottom line is they've got a $5.50 deal. Those minority shareholders have said yes. Management has said yes. So that deal will happen and close, in the next month or two. And then you've got to the announcement, Kuitino got a bid. ARC was the major shareholder there again, bid from an American company to buy the company for $24.75. and the stock has popped a couple bucks here on that deal. And the vote for that and the close will be in December. So, if there's companies that are wanting to do strategic deals, the American companies look at the Canadian companies as trading at 50 cents on the dollar versus equivalent American companies. And so they realize there's a big arbitrage benefit for them and a value creation for their shareholders, private equity holders. And so that's why a deal like Kowitno was able to happen.
Joseph, how do you invest around any of these M&A deals? So do they attract you, the end result company? Do you see any opportunities with any of these or even predicting future M&A deals?
Yeah, I think there's going to be consolidation in a number of areas. So if you look at the Montney and Duvernay and stuff like that, and who's on the fairway and who could get taken over. So we own Birchcliff, which we've liked for a long time. You and I have talked about that many times before. But there's other companies that are in the fairway that would be consolidators. We've seen Tourmaline take over Crew, company that we used to own, and we thought, again, you're in the right fairway in BC. Consolidation would take you over. You've got Logan Energy, which is on that fairway. So you're going to have many companies that potentially, could get taken over, that could see deals. And I think that, just find the ones that fit your investment thesis and have good balance sheets and don't have debt problems. Some of them don't pay dividends because they're growing faster, like Logan and Kowitno. And so, we've seen the takeover there. In the case of Birchcliff, they're just standing steady, paying down debt, and they're going to start hitting the gas pedal in 2027 and start growing more faster then. And so they would be they have a 25 plus, I think, over 30 years of reserves, and that's what you need if you want to be a potential takeover by somebody who needs it for LNG exports. So Birchcliff had a standing room only audience at our conference, and companies that are already very big in the natural gas sector in those areas, like Tourmaline, also had standing rooms. So again, people know these stocks in the right fairway and have great prospects and upside. And we did see the audience at our conference go to those rooms.
Well, Joseph, M&A also brings up two other interesting angles. One is that companies can decide to diversify their jurisdictions. They may become split between Canada and the U.S., or they may pick a different basin than they're in. And the other thing is the mix of products. Some companies may be more oil heavy and then bring in that nat gas, like you're saying, or some companies may bring in just a nice blend of oil, nat gas, and natural gas liquids. Do you have any thoughts there as far as companies that decide to press their bets in one basin versus switching and diversifying and or bringing in different mix to their product line?
Yeah, for example, Whitecap, in Q2, they had 64% liquids. And with the merger of Varen, which had more natural gas, and again, they're building out their natural gas business over time because they want that LNG export capacity. They were 61% liquids in Q3. They could go down to the mid-50s as they build out their Montney and Duvernay. They want the liquids that come off of them, and because they're in the right fairway, but they also want to be there as a bigger player on the export market for natural gas. And so I think you'll see more and more companies consider doing that going forward.
All right, Joseph, we're going to wrap it up here. We're out of time for this weekend show, but thanks for diving into the energy sector with us. I feel like we're all just waiting for a more substantial turn here to really bring in some more, profitable trades within some of these underlying equities. But even at current prices, these companies do seem to be doing okay. But again, that rising price of oil or natural gas can really bring in those investors that a lot of people are still waiting for, a bit more momentum in this sector. Again, Josef Schachter is the founder and editor of the Schachter Energy Report. You can click the link in the show notes within the posting on our website, podcast, or YouTube channel. And feel free to reach out to us if you want to be put in touch with Joseph for any of his work. Everyone, thanks for tuning in to this weekend show. We hope you all have a great rest of your weekend, and please go back through our website, podcast, YouTube channel, and even Substack page. Just search the KE Report, and you can listen to all our daily editorials covering market moves and company updates. Everyone, have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.